liquidity pools. Okay, so let's get started with liquidity pools. What is a liquidity pool? A liquidity pool is where there's a bunch of liquidity, unfilled orders, bank levels, imbalances, but within a zone. So everything that we've covered is within these liquidity pools. However, to understand liquidity pools, you must understand a wick or schematic, a really simple one, which is the equal lows setup with a bit of a twist to it. So let's look at equal lows and how does it look like. There's really simple stuff. Price can be dropping to the downside, dropping. And when you see equal lows, something clear like this, equal lows, what do you think the majority of traders are doing when they see a double bottom? Obviously, this is taught as a reversal. You can obviously enter at a double bottom with your stop loss below there, target where structure is, or even the previous high, or you could look for a break of the neckline, retest, and a continuation to the upside, right? This is what we've been taught at the very start of your trading journey. Even myself, you enter on the retest and your stop loss conservatively around there, TP back up to the previous structure. Now, the psychology behind it is the fact that retail have their stop losses right below. And the reason we're aiming for the stops is because there's lots of liquidity. So smart money and the composite man are aiming for your stop losses if you're trading a double bottom setup, because this is where they can see on the on-chain analysis, they can actually see where your orders are at. So they want to get in as cheap as possible, use the liquidity to push price up. So for example, this equal low setup, the majority of the time it gets stopped out and then it rallies to the upside. It's normally what happens. This doesn't even happen sometimes on a break and retest. A lot of the times there's a double bottom and then it just completely does a stop hunt and then it goes long, right? So why does it go long? It's because it's filling up liquidity. But where is the liquidity? So liquidity is right below the double bottom. But the little twist that I've added to it, if I just update this chart and start again, it looks something like this. So for example, price can be rallying to the upside. It's a bit of structure here. It rallies again, goes down. We see the equal low setup. Once we see the equal low setup, as you can see, equal low setup, where is liquidity? So liquidity is right below. However, what you need to pay attention to is not only the liquidity below the double bottom, since there's multiple stop losses here, but also the liquidity that is right below the previous structures, because there is retail traders that have very conservative stop losses, not only below the double bottom, but below the previous structure, in the event that they believe that it's very unlikely for price to take them out because it's making new highs. You know, it's made a new high here, it's making structure higher highs and higher lows. There's no way you're going to get stopped out with your stop losses at a very conservative area. But normally that's not the case. So what happens now is price does a stop hunt of both the double bottom and the previous structure. So to implement where the liquidity pool is at, it's within this gap here. This is the gap where the liquidity pool is at from the previous structure and the previous low. So the way we draw a liquidity pool is you get this indicated to the square, do your zone from approximately this level, and this is a valid liquidity pool. And this is where you want to enter, right? You want to enter approximately around down here, look for some form of a stop hunt, and then a rally to the upside. And this is why we implement our patterns, because it'll be in confluence with the liquidity pool. So normally, I done this wrong. Normally it'll be like this, and it'll be in confluence. The third tap, 1, 2, and 3, it will be in confluence with a stop hunt of the double bottom and a stop hunt of the previous structure. Now let's look at some equal highs. Same principle. So price can be dropping, etc. And then we may see some equal highs. Doesn't have to be perfect. It could even be tiny, just like this. Double top, equal highs. And then what do we see? So let's actually draw the equal highs. Equal highs, there we go. Let's do it perfect for you guys. Now, sometimes we'll do a break of the structure, which is enticing traders to go short. And when it entices traders to go short, what happens? It does a complete stop hunt of this support, then a stop hunt of this double top or equal highs, then a stop hunt of this previous structure where the liquidity pool is at, right? And this is normally what happens. So we're avoiding all the stop losses that you see on the smaller time frames, on the buys, on the sells, on the bigger buys, on the bigger sells. So this is why we use the liquidity pool that's based between the previous structure of the equal highs and the previous structure from here to the left. So we're using this range here as your liquidity pool. And this is why you also need to look for your pattern, which will be in confluence with the 1, 2, and 3, but make sure it's a stop point of this previous structure and a stop point of the equal highs. And then you will see normally there'll be some form of a bearish pattern, boomerang, and then we sell it to the downside. So this is how you draw the liquidity pool. Simple stuff. Those are examples of a high probability liquidity pool. So you need the equal lows, equal highs with a pattern. A low probability liquidity pool, which is still valid, but you can still use it in conjunction with your pattern. It's just simple zones. So for example, price could be rallying to the downside, it could reverse, go long, and I'm just completely freestyling this. I'm going to show you how to draw the liquidity pools. There we go. So again, simple stuff. There's liquidity right there. We're using this particular gap, right? Simple zones, simple stuff, right? Where else is there a liquidity pool? Let's say down here is a liquidity pool, but obviously that would have got stopped out. But why did it get stopped out? It's because there's probably not any equal lows or any patterns here, right? This is what's important. You know, these liquidity pools still play out. Another liquidity pool would be approximately from this area, right? And as you can see, okay, this one potentially, yes, played out. So liquidity pools are simply just the gap between the previous structure, and we're using that, or the previous structure from here, and we're using this as a liquidity pool, or the previous structure from this particular area. And you notice that most of the time, decent valid liquidity pool would be just after a break of structure. Break of structure, rallies to the upside, again, break of structure, rallies to the upside, and we're using this gap between these two structure points. So the previous minor higher low and this higher low as well. So again, there's another liquidity pool approximately around here, as you can see. Also broke a bit of structure and it played out pretty well, as you can see. We're using this gap. Oh, look, and a little third tap pattern. So this normally happens in the markets in terms of fractals, right? So this is the best way to look at liquidity pools and equal lows, patterns, etc. But now we're going to implement everything together and use liquidity pools, break of structure, banker blocks, trend lines, bank levels, imbalances, momentum, compression. We need to put everything together so you have as many confluences as possible, and then you can have a high probability trade. So in this example, again, equal lows, we draw the liquidity from the previous structure, starting from the previous low. And there we have a valid liquidity pool, right? Valid liquidity pool. The next area that I could see would be this particular high. So it did make equal lows. It done a stop one of the double bottom, done a stop one of the previous structure. Now we have equal highs. And where do we look for? You jump the equal highs, then you go to the previous structure and you do your zone from here to the previous structure there. So let's actually draw our zone. Actually add this again. Our zone will be from there, and there we have a nice rejection. So this is how the market moves. Now, implementing equal lows and equal highs with the previous structure stop hunt is how the market is constantly moving. You're literally catching the stop hunt of both areas, right? So these are the high probability liquidity pools, the valid liquidity pools, which is different to high probability ones, is this. So we have the distance between this structure and this structure, right? So this would be a liquidity pool. But again, it completely failed because there's no pattern, there's no equal lows, it's just a liquidity pool. But they do play out every now and again. As you can see from this area, it did actually play out. or even this particular area, it played out, right? So you can see the distance here. You're connecting these two zones, and this is how you draw your liquidity pool. Where is price likely to go to next? Let's see. There is a liquidity pool here. So this one probably played out. Break and retest. The next liquidity pool, can't really see anything. There's no structure here, right? So the reason there's no structure is because the next liquidity pool would be from this area here. So from this low and this low. The most relevant previous structures is where the next level of the liquidity pool is at. And this is where you want to get involved. But again, for a high probability trade, make sure there is either some form of a pattern. And when you look to the left, is this equal lows here? Then yes, this is a pretty decent liquidity pool. But just make sure that there needs to be some form of a pattern or a equal low setup, and then you look for the stop on. So these are the high probability trades. Again, liquidity pools here. That will be your plan A once it rallies to the upside. Plan B liquidity pool would be from down there, right? So many liquidity pools, as you can see. There's plan A's, plan B's, but again, which one do you take? Once price is approaching your area and you're thinking, okay, do I take plan A or do I take plan B? Really depends on the pattern. So if you see something like this and price is rallying, and it does something like this, is there a pattern here? No, there is no pattern, right? Because if you draw your trend line, there is no pattern. There's no pattern here, so you can't really, this is not a pattern. This is way, way, way too expanded. If, however, priced on something like this, and you see a clear type pattern, then yes, plan A is valid, right? For plan B to be valid, again, we need to see some form of a pattern. So where plan A could be invalidated, it will look something like this. Be rallying. There could be lots of momentum. But notice how, if we actually update this, we've only got 1, 2, and we can anticipate where price is likely to go to next. So we've got 1, 2, and if you calculate, it's definitely going to do a stop on of this because it's likely to come up to where? This area, 1, 2, 3. So this pattern here, and you're forecasting where it's likely to go to on the third tap. And if it lands on plan B liquidity pool, then you know that when price is approaching this area, and if you set your order, just cancel the liquidity pool. You just cancel it because you know it's going to get stopped out. And then you obviously catch the trade, and then you're obviously in profit. So always, always, always update your liquidity pools depending on the pattern that is approaching either plan A or plan B. That is very, very important. The same way that we update the patterns and the trend lines, we also update the bank levels, we update the imbalances, the liquidity pools, even the equal highs and the equal lows. Everything always needs to be updated. Always, always, always.